Welcome back to EDS, and in this video I'm going to show you a day in the life of my trading routine step by step. So the first thing I want to say is that I do not spend all day looking at the charts. I do not spend all day looking at my account. In fact, I don't look at charts at all, and I probably spend about 10 minutes a day trading, opening positions, managing positions, etc. This is a very hands-off, stress-free style of trading, and it gives me very consistent returns, and it gives me very high returns on my capital, and I'm going to show you exactly how to do it and what I do. So we're going to be writing options contracts because that gives us a high probability of success. Well, it allows us to get a high probability of success if we want it, and I write those contracts on futures contracts. And the reason for that is because futures uses span margin, and span margin allows us to be capital efficient, and that's what's going to give us the high returns on capital without needing to sink in too much buying power. So this is good for if you have a small account, large account, it doesn't matter. I've grown multiple small accounts using this, and I also manage larger accounts doing this exact same thing as well. So you want to open up a watch list of futures that have options available to trade. If your broker doesn't display that information natively, then just take note of these ticker symbols. I then order everything from high to low IV rank, and I'm only interested in things with an IV rank of 30 or higher. An IV rank of 30 is considered high, or over 30 is considered high, over 50 is considered very high. Option prices rise when volatility rises, and we are essentially going to be short the contracts. So we want to sell high, buy low. So the higher the implied volatility, the better, and we will get higher returns on our capital as well by default. You can use this with equities, you can use this with futures, it doesn't matter. The only real purpose of futures in this instance is to capitalize on span margin. If you have a PM account, then it doesn't, you can just trade anything, and your returns will be the same as if you didn't have a PM account. But if you don't have a PM account, then this is like a little hack that you can use to get your account to the level that it needs to be at in order to apply and get accepted for a PM account. So if you have a smaller account, you want to stick to currencies. If you have a larger account, you can trade whatever you like. So let's just have a look at ZB. So ZB is the 30-year Treasury bond futures contract. It has an IV rank of 42.2 and an IV of 12.2%. So let's just open up the list of expiration dates for ZB, and on the left we have our option expiration dates. Next to it we have the corresponding futures contract. So January 31st, February 7th, February 14th, February 21st, all line up with the H5 contract. And then we have the M5 and U5 contracts below. We don't need to worry too much about the specific futures contracts because all good brokers will display this information in a similar way. We just want to focus on the option expiration dates. So we want to pick an expiration date that's not a weekly. We want it to be a monthly. As you can see here, the top three are weeklies. You can see that with this W. So we want it to be a monthly, and we want it to be between 30 and 60 days out in time. So the only one that actually fits that criteria is March 21st, the ZBM5 contract with 51 days still left on it. And we're going to open that up, and now we are presented with the options chain. Here we are going to sell one call and one put. And we're going to sell them outside of the expected move, in and around the 1 standard deviation level, and that will land in between 15 and 20 deltas most of the time. So very quickly, just to show you how to do that, we have our on the call side, we're going to sell the 19 delta strike at 119, and then we're going to do this exact same thing, 19 deltas on the put side at the 110 strike. As you can see, we are outside the expected move. That's shown with this orange bar. Our contracts are up against the 1 standard deviation level, and we're in between 15 and 20 deltas. So 3 points of confluence there that you can use to structure your trade. And what we want is for price to stay within this range in between the two contracts that we've created. And we have a pop of 70%. So that means we have a probability of profit of 70%. So we've got a 70% chance of making at least a penny on this trade at the point of expiration. Now, if we wanted to not wait until expiration and get out at, say, 50% of max profit, then we have this P50 number here, which isn't displayed for futures. However, it's typically 10 to 15% higher than our pop. So we're looking at probabilities of success of between 70 and 85%. Now, also another thing to keep in mind, that implied volatility is overstated compared to actual volatility about 75 to 80% of the time. So our actual probabilities of success are much higher. This also doesn't take into account any adjustments that we make, any trade management, etc., things like that, any adjustments. So in actual reality, our probabilities of success will be far in excess of 70 to 85%, although we could just work off, say, 80% to start with. Anything over 50% is considered a high probability trade, so 80% is very, very good. Now, how much money can we make on this? Well, we're going to collect $1,602.50 up front, and that's going to be deposited to our cash balance by our broker automatically as soon as this order gets filled. The broker is going to require just under 4.2k in buying power to open this position, so we're looking at about a 25% return here in 51 days, which is very, very good. You can play around and look at different futures contracts, going with the same delta, 19, 20 deltas on either side with different futures contracts will give you different returns on capital. But as you can see here, we're getting a very, very good return, and you can get a higher return. You can just be more aggressive. You can go out to the 24, 25 delta. Now we collect just under 1.5k, and our broker is going to require 4.6 to open this account. So, we can just get a higher return. Our pop has reduced by 5% slightly, so it's not the end of the world. It's still a very high probability trade, and generally speaking, you can, in a very high IV environment, you can even go up to the 30 delta if you really wanted to. However, if you are going to do this, do make sure you know what you're doing. Do make sure that you know how to manage risk and make adjustments effectively. You also need to know how to manage your deltas and rebalance your deltas. It helps if you know how to properly buy the guts and sell the wings, etc. This is just going to allow you to follow the market, so you don't really need to worry about which way the market goes. I personally don't care what the market does. I'm simply just playing the Greeks. I'm working off of volatility contraction, theta decay, and my job is to stay in business and just manage deltas, manage theta in my portfolio, and I just keep doing this over and over and over again on as many positions as I can, whilst still managing risk effectively, which I'm going to show you a little bit more on how to do in just a second. Our edge is built in, okay, when we're writing options contracts, so you don't need to try and figure out something that nobody else knows, because always remember that you don't know anything, or I don't know anything. I won't speak for anybody else. I don't know anything that the market doesn't already know, except the only exception to that would be insider information, insider trading. But you can't place any trades legally based on that information anyway. So that's it's pointless. So I am of the belief that the market is efficient, and there's nothing that I know that the market doesn't already know. So I'm not going to pretend to try and know something. I'm just simply collecting premium like an insurance company, like a casino, managing deltas, following the market, and I don't really care what the market does, to be honest with you. As long as you keep your position sizes in check, everything will be fine over the long run. But now we've increased our deltas up to the 30 level, the 30 delta mark. Now we're collecting just under 2k in buying power, and our buying power requirement is just under 5k. So our return is just increasing more and more. Our pop has reduced by another 5%. It's at 60% now. However, that's absolutely fine. Our P50 would be in and around 70-75%. It'd actually be higher than that because IV is overstated compared to actual volatility. So that's not even taking into account adjustments. So the really great thing about selling naked positions like this, naked meaning that there's no long contracts covering our short contracts, is that you can pretty much roll indefinitely as long as you are logging into your brokerage account every day, every second day. Spend 5 minutes, 10 minutes looking over your positions, looking at your deltas, and just rebalance if you need to rebalance. Don't let the market get too far away from you, and just have a certain level of market awareness. And as long as you're on point, there's no reason why you can't just keep managing your deltas, keep making adjustments, keep rolling your contracts, etc., sell more time, and just eventually work any losing position back into a break even or a profit, and you could just keep rolling indefinitely. So this is a very, very powerful thing, and I do want to tell you a little bit about managing your buying power. So we've created a free position sizing template. The link is in the description. And this is what it looks like. So you enter in the size of your portfolio at the top. Say if you have a $250,000 account, you can then enter in the VIX level below. Say if it's 32.6, and then everything will be calculated below for you automatically. All you need to do is just use this information to form the backbone of your portfolio. And as long as you follow this as a guideline, you'll be absolutely fine. If you have a small account, like a super small account, then you may need to be more aggressive than these numbers. If you have a larger account, you definitely should not be violating these numbers. And as long as you follow this, you'll be fine. If you do want to learn more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium. Get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we place, how we manage risk, how we make adjustments. The portfolio that we give access to our members inside is a very small portfolio, so we deliberately did it that way so that whether you have a small account or a large account, everybody can extract value from it. And there is a full course as well, so no prior knowledge is required. We will teach you everything from start to finish. If you get stuck, you can ask questions. I myself personally respond to every single question in there. However, there are also other like-minded individuals in there as well if you want to speak to anybody else. And there's a 100% money back guarantee. So once you've studied the course, followed our trades for at least 6 months, if you haven't been profitable at that point, or if you aren't profitable at that point, then we'll work with you for free until you are, or you can just request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to not keep you dependent on us. We do not want to keep you dependent on us. We want to teach you the skill. And once you have the skill, you have it for life. Nobody can ever take it away from you. And we aim to get you to a point where you are completely self-sufficient within 6 to 12 months. So you're always welcome to stay and be a part of the community after that. However, 6 to 12 months and you should be good to go. And it's something that you can do for the rest of your life, no matter what. I mean, provided you have a good broker, you can literally trade off of a payphone from any corner in the world. That's not an exaggeration. So with that being said, I will see you guys on the inside.